I'll keep my stops really tight and move them up quickly as I can to profit land. If you follow the rules of A.M.P.D, you're going to have the gutter, which is the defense first strategy, to keep your ball from going out of the lane and causing you to really lose more money than you're comfortable with.
Last Week in the Market is now Right of the Chart, the podcast for self-guided independent traders. Hey everybody, thanks for joining the podcast today. I am Sean Vincent. I am the voice of Right of the Chart. Adam Sarhan, he's the brains behind Right of the Chart. Adam's not joining us today, but instead I'm going to be talking to a guy named John Frost. He is an adherent to the A.M.P.D trading strategy. He is currently running a model portfolio to test out the A.M.P trading strategy to see if it's right for him to invest his own money. So far, he's been very happy with it. He's had a good year. It's a funny time in the market. We've just had a couple of drawdowns recently, a rally attempt last month that failed, a new rally attempt happening this week. I'm going to talk with John about how he uses the A.M.P trading strategy to figure out how to get in and out of the market during these very interesting times. Along the way, we're going to talk a little bit about how the A.M.P trading strategy is a little bit like bowling. But before we get to all of that, remember that in the market, the past does not predict the future. No results are typical, and there is inherent risk when trading in the market. This podcast is for educational purposes and does not constitute financial advice. It is Friday, September 13th, 2024, and here's what happened last week in the market. On Monday, we saw the start of a new rally attempt in the NASDAQ 100, the QQQ. That attempt was confirmed with a follow-through day. On Wednesday, it's ended up for the week, up for the day. Today, the big question is it time to get back in? We're going to talk about it with our friend John Frost. So, John, our listeners who've been with us for a long time may have recalled a conversation you and I had some months ago. You, like me, are a student of the A.M.P trading system. Is that fair to say?
Yeah, I came to it a few months after you, but I've been keeping my own paper trading since about December of last year. So,
sure, we'll call that a model portfolio.
Yeah, model portfolio.
Here's a big question, since you've been working with your model portfolio for about a year. What's one of the defining characteristics of the A.M.P trading strategy that's affected your decisions that you've made?
Well, the whole idea of to lose small and win big by, using stops. So I'm looking for, to sum it up, I'm looking for leading stocks that have indicators going in the right direction, that I'm comfortable with investing in those stocks and confident that they're going to go up a large enough percentage based off of where the support is, so that I'll be able to make some profit off of that. And then I set my stops accordingly to market conditions and how comfortable I am on that particular stock in terms of whether it's going to be a tight stock, 5%, or a loose stop, 7, or maybe 8, or even 9%. And if the support is kind of in that range, then I'm likely to invest in that stock. And it's hard to express in one term, but A.M.P.D is the rules by which I invest.
Right, and the D is the defense first, and a big part of the defense tactic in A.M.P is those protective stops. You gave me a great analogy the other day to describe the protective value of stops, if you recall. It had something to do with bowling.
Oh, yeah, bowling. Well, we were talking about what to do if you're just getting into doing some individual stock trading, right?
Yeah.
And how to help yourself feel comfortable with it. And that's what these paper trading or uh,
Model
model
portfolios.
portfolios allow you to do. When you walk into a bowling alley the first time as a toddler or first grader or whatever, your bowling lane is going to have not only the regular gutters that everybody has, but additional gutters that keep you on the lane and and without going, your ball going wildly crazy into another lane, and you're pretty much guaranteed to hit a pin at the end of the lane, no matter how bad you throw the ball down the court. And so, when you're getting started, having this model portfolio to help you find out how the ball will move on the lane, how many pins you're likely to get on a particular strike, how hard you have to throw the ball, or
Yeah.
what percentage of your portfolio you want to invest in any one particular stock. All those things you can do with the toddler uh,
The
uh,
bumpers.
bumpers on, right? And
Yeah.
then as you get more comfortable, you can take those toddler bumpers off and maybe put some of your own actual real money in the market. But thanks to the A.M.P.D, you still have another set of protections out there. The gutters are still there, and that's going to keep, if you follow the rules of A.M.P.D, you're going to have the gutter, which is the defense first strategy, to keep your ball from going out of the lane and causing you to really lose more money than you're comfortable with, while at the same time, if the ball is going quickly down the lane, the stock is rising as you predicted, you're going to knock down some pins, make some money. Not every single ball down the alley is going to be a strike because you're just getting started, but more often than not, you're going to win. And then the ones that you lose, aren't going to be bad because you have the gutter for protection,
Because
or
the
the
gutters,
defense first,
they're guardrails,
the
to use
guardrails.
a broader metaphorical term.
Yeah, which are
And in
are
and
your stops.
yeah, and in your analogy, the bumpers then in the gutters would be having the discipline to start a model portfolio to test out the strategy before you commit your real money to it, right?
Yeah, that's exactly what I'm using it for. So, and
To Go ahead.
you're I think you're doing it for as long as I've been doing it, which is almost a year now, or will be a year in December. Uh, I'm keeping a journal, at least a couple lines, some notations of the lessons I learned along the way. When to buy a half position in a stock, or oh no, I accidentally kept my stops way too low on this one, and I didn't follow the market news, so the market dropped out from underneath me, and I lost a lot more money on that stock than I intended to. So I
Yeah.
have a little history of the lessons I've learned, and then I can bring that forward and apply that to when I actually do have money in the market.
Yeah, allowing you to make those trades with more confidence. I have two really important questions for you, John. One is when you were a child, they didn't have those bumpers in the gutters at bowling alleys, if I recall. Us Gen Xers, we were just thrown at it. It was our kids who got the benefit of the bumpers in the gutters, right?
Yeah, I think I don't remember the I do remember having the gutter bumpers at the bowling alleys I was at, but I don't remember having the little rig that the kids get to use these days, where they put the ball on the top of the
Oh
rig,
yeah, they don't have to throw it; they can just
and they don't
line
have
up
to
the
throw it; it just
ramp and
rolls
drop
right
it.
down there, and that's a convenience as much for the bowling alley as for the person, so the ball doesn't get stopped in the middle and you don't have to
Sure.
run down there and grab it yourself. But uh, I the analogy that I see there is, you know, when I was starting to invest in stocks the first time around, way back in the late 1990s,
Yeah.
um, I had to read the newspaper. I had to.
Right.
Uh, my aunt who was helping me, she subscribed to Barron's. She subscribed to Wall Street Journal. You know, that's how she learned what to trade and what not to trade. And then she had to call her broker usually and say, make a trade for me. or by that time, I think we were using the fax, but as time has progressive, we've had more and more tools that make this easier. And there's really never been a better time to be an independent investor or trader in the market.
And if I recall our conversations together before you encountered Adam's AMP trading strategy, you weren't really aware of protective stops as a tool in a
Yeah,
self-guided independent trader's toolbox.
yes, I would say I gave up independent trading shortly after my initial entry into it. Most partially because I was working for a firm that did institutional trading, and they didn't want you to have individual stocks. So all my money went into funds at that point.
Yeah.
Um, but then I just never picked it up again after that. So now having the opportunity to come back and reacquire some skills I had before and learn a whole bunch of new skills, including Adam's strategy, that's been a real benefit to me.
And so when you're executing the AMP trading strategy, there's really two choices, right? There's when to get into a stock and when to get out of a stock. And we're talking, it's September 13th, 2024. We're in a situation where throughout uh, most of 2024, at least until the end of July, we're enjoying a pretty long, mostly uninterrupted rally. Then we had a trip down uh, at the beginning of August, a pretty rapid recovery, but not all the way to the highs. At least I'm looking at the QQQ as a leading indices when I talk about this, and the tech sector, which had led through this recent rally. It didn't fully recover. It took another leg down, and now we're 5 days into uh, a second rally attempt since the July highs. And so that means that as AMP traders, a lot of us had stops triggered when the market pulled back. There was an opportunity to get back in. There's another choice to get back in and where to set our stops. And then that rally didn't last so long, and we took another dip below the 50-day moving average, 21-day moving average. And I know for me, I had set my stops pretty tight, not believing that we'd have a rapid rebound. So I've stopped out of most of my positions. And now it's time to decide after follow through day, what on looks like Wednesday, a big follow through day moving up, got about the 21-day moving average for the QQQ. When is the right time to get back engaged? And you and I were talking offline earlier, slightly different philosophies on how to do it this time, right? Tell me your thinking.
Right. Well, uh, I think Adam's strategy. My interpretation of the A.M.P.D strategy is you want to wait until you have a follow through day. But I am also looking at a couple other indicators of the
Sure.
strength of.
And real quick, before I get to the other indicators for the listeners, a follow through day is that when you have, after a rally attempt has started and you have an up day, then you're looking for a day where the market moves up more than 1.3% on heavier volume than the day before. And we saw that this week on Wednesday. And so that's a
Right.
big indicator that um, the trading window might be opening. And then you
Right.
were about to say about some other indicators that you like to use.
Yeah. So I look at that. Whether there is a follow through day, and then I also look at uh, things like the shape of the trading that day. Did the stock, even though it might have been a down day, was all the trading towards the top of the candle, or um, kind of what is the momentum? And so I'll use another tool called the RSI indicator, which is a momentum indicator, and I also use the MACD, which is also a momentum indicator that has basically two trend lines, and when the one trend line passes the other, beneath there's a much you can go to YouTube, watch lots of videos on how to use the MACD, but I'm just keeping an eye on that one trend, and then also that the momentum is green.
Yeah.
So specifically with the QQQ, I saw a reversal and uh, felt like almost a follow through day, but then there was a market adjustment day right after that, and
Hmm.
QQQ and everything went far down. So, but then there was two subsequent days following that really positive with a lot of the momentum towards the top of the candle, and the RSI was good and the MACD was good, and then it looked like it was going to make a cross in the MACD, and so that's when I bought it on. And so far so good because it's on its fourth consecutive day up since then.
Interesting. I use fewer indicators than you do, and maybe just because I can't reconcile them all in my head. I've been
Yeah, it's
keeping
not
it
a checklist. It's more of it's
a guide,
a
right?
guide. Yeah. So
Yeah, and I'm not saying I'm any better off for using fewer indicators than you are, John, because I think the point I'm leading up to is that as self-guided independent traders, as we get a feel for how we read the market, I'm finding that every trader has their own set of indicators that they like to rely on, and even chart shapes that they like to use. You're a candlestick guy. I have my chart set to the OHLC, the open, low, high, close uh, setup, or is it OHLC? I can never remember. I don't think it matters what you call it,
it's the
right? But
ones that look like feathers, though.
yeah, they give us different information about the market, and so in the model portfolio that I've been running that's over on Chart Your Trade now. Uh, Here's what happened when I guess I have some skepticism about whether this rally attempt is going to be the one that breaks out past the last lower high, the last attempt, and is going to take us to new heights. And I got beat up a little getting in last time, and I've gotten beaten up a little bit getting out. And part of that, the P in A.M.P.D is psychological analysis. And so I stopped out of a bunch of positions this week because last weekend I tightened all my stops, expecting that if things gave up, then I'd dip below the 21-day moving average and some of my winners that they were gonna go down pretty far. And it turned out they didn't. A lot of them went just below my stops and then went back up. So, and there might be a recency bias on this since I've had that experience. But what I did is one of the big indicators I like to watch is I look for downward trend lines, which is I'm gonna on the chart of the QQQ. If our folks want to go look it up, you'll see back at the end of July, beginning of August is where we had the high. It fell from there until the middle of August, and they came back up. So if the high was, let's say, a little over, 500, 505, then the next rally attempt went up to about 480. And we're at right now, as we talk, 474 in the QQQ. And you can actually go draw a straight diagonal line from the top of the the height over the top of the last rally attempt to where we're at right now. And actually, while we've been talking, it's falling. So I'm waiting. I'm treating that downward trend line as a line of resistance. And although I do have a little FOMO, since I have seen the huge gains that the QQQ's made in the last couple of days, I decided last week, before we saw any of the improvement this week, that what I was going to do is I was going to wait for the price to break out above that downward trend line before I turned my trading window back on. And then I was going to do it at half positions with tight stops. And then what I really want to see is it bust out above that 485 number, which was the lower high that we just went off of. So I only tell that story because um, I don't think either one of us is right or either one of us is wrong about our decisions. I think what's important is that you had your parameters set for what you wanted to see. And when you saw them, then you made your trades. It hasn't quite triggered for my parameters yet. I haven't made my trades yet. The important part of that is neither one of us has been hijacked by the exciting activity in the market this week. We have a plan and we're sticking to it. And that's really the core of the discipline, right?
Yeah, I think you're taking your risk off the table before you get into the market, and I'm trying to take my risk off the table after, when I'm comfortable getting in the market, but I'll keep my stops really tight and move them up quickly as I can to profit land, and then at that point I'll reassess.
You know, I like that term profit land. It's a place you can be. And I'll say I joked about getting beat up a little bit on this last downturn, but the truth is, going into last week, I had all my stops up into profit land for almost the entire portfolio. They were very modest profits, many of them, but they were profits just the same. And because I didn't stop out of everything, I've got two positions left that are doing really well, and the rest of it's in cash, and it's not there. It's not at risk, obviously. Um, so I'm going to be excited to see what happens over the next 2 weeks, and maybe we can reconvene and compare notes, see how we did.
Yeah, sure. Be happy to do that.
All right, everybody, that is the podcast for today. Appreciate you listening through to the end. I'm going to keep my eye on the QQQ. It's closed now, right about at that downward trend line, that line of resistance. I'm looking for it to break. I'm going to put my notes together for the portfolio. I'll see you next week. Until then, as we always say, keep your losses small and let your winners fly.
Oh yeah, bowling.